In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
Hey, welcome back to all of our market rebels and YouTubers out there. And Stu, another wild day in the markets.
It's always a wild day in the markets, Bill. If it wasn't a wild day in the markets, it wouldn't be any fun.
It wouldn't be any fun. I think we saw tried to rally, if I remember correctly, like around 3 o'clock or so. But I think we finished, 0.75% down or so on SPY.
It actually ticked down since we were last talking. It's actually down a little over 1% right now.
Okay.
The Dow's down about 0.75%. Yeah, it was, they tried to rally it back, but failed.
Failed.
And here we are.
Some interesting points in time on those moving averages, as we were talking about in our Q&A.
Yeah, kind of broke through, right?
But today, what we wanted to do is to show you another interesting topic. And you have to understand that one of our underlying themes in Coach's Corner is to really show people that options are not as easy as they think they are. Everybody thinks, oh, you buy a call because you think the stock's going up. What else do you need to know? Well, you do need to know a lot more than that. If it were only that easy, there's a lot of moving parts. Mm-hmm. And so we like to show people what sometimes appear to be simple topics, but aren't really so simple. And today is a perfect example of that, Stu. And I know you're going to know what this is once I start showing it. As a market maker, you have to be very aware of this. But let's start off with our Chalk Talk question. This is a little thought-provoking question for everyone. So if you can, jot down your answer, and then we'll come back and visit it at the end of the presentation. So here we go.
I got my pen. I'm ready.
Yeah, you got your pen. You're going to write this down? All right, here we go. Yeah. Start off with a tough one. The stock is trading at 100.
Yeah.
You own the 1-year $100 call.
1-year $100 call.
And our question is this the at-the-money strike? Now, you know why I'm asking this question, and I'm going to give people a hint. Most people would say, well, absolutely, that's the definition, that the at-the-money strike is the strike price that is equal to the current stock price, or because that's fairly rare to see it exactly equal, the one that's closest. That's the definition that most people learn.
Isn't that the one that's in the books? Isn't that the one?
And actually, very true. In most of your books.
Information cascade, yada, yada, yada.
Yep. So in most cases, it's a decent definition to get the ball rolling and to get you started.
Decent is a loose word there.
Very, very loose. But I can understand why somebody maybe who is just starting out that they give them as a basic definition. But what we want to show you is that how this can cause major problems.
Can really cause a lot of problems. You got to pay attention.
A ton. I know you get a lot of coaching questions with this. So here's our topic for today. What's the at-the-money strike?
Let me back up 1 second. So the coaching questions that I get on this topic, which people don't generally even know that it is a topic, is because the stock actually went their way.
Yep.
And they didn't make any money.
Well, you know why that happens, though, Stu? Because options are risky and the market maker saw my order and ripped me off. right? That's
I
what
know,
everybody
man.
says is the reason.
I know. I hate when that happens.
But they don't realize, no, there are far more likely scenarios why the stock can do exactly what you thought it was going to do and that you still lost. And this
Yeah.
is going to be one of those instances. We'll show
This
you
is one of them. Yep.
I'll show you a specific example at the end. But right now, let's start off with a basic definition for people who might not know. There's I guess you'd call it a generic or a collective term called moneyness. Now, you're not going to find that in the dictionary. It's a kind of an options trading term, but it really is this collective term meaning if, is the option in the money, at the money, out of the money. That's what we would call the moneyness of the option. So here are the three basic categories, the three basic flavors that we get. We get in the money, out of the money, and at the money. This is one we're going to explore today, but let's do a quick definition. What is an in the money strike? Well, the in the money options have intrinsic value. That's an easy way to remember it. In the money and intrinsic value. And because of that, they will have relatively high deltas, for sure over 50. But depending on time, volatility, it could be 60, 70 deltas, even though there might not be all that in the money all that far. But they're going to be as a benchmark above 50. So if you like a better definition, for a call, it's whenever we have the strike price less than the current stock price, or for puts will be the opposite. The strike should be greater than the stock. So for example, if we have the stock at 100, if we have the $95 call, $95 call would be an in the money call. Specifically, it's 5 points in the money.
Yeah, and what I tell people in my sessions is, look, don't try and memorize anything.
Right.
Don't try and memorize an equation. Just remember that it's how much is it in the money. It's the difference between the strike price and the stock price. That's it. That's how much it's in the money.
Right. But we have to understand it's in the right direction, because we could also look at the 105 call and say the difference is 5. So you have to, that's why I usually tell people a better definition is to think of an immediate advantage. Would you have the incentive, or at least understand why somebody would want to exercise the 95 call when the stock is 100? Yeah, it's giving you a better purchase price. If you had the 105 call, you'd say, why would you exercise and pay 105 when you can pay 100 right now in the markets?
That's kind of funny. And oftentimes, because I've been doing this so long, I don't even think that somebody would consider
the other side. Yeah.
Why would you exercise a 105 call if you can buy the deliverable at 100? So, it can't be out in the money.
It can't be an in the money option, right? But just in case, I like to throw that out there in case somebody says, oh, it's just the difference. Well, it's only in one direction. So here's the direction. For the call, we want to see the strikes below the stock price, and for the puts above. Those will be in the money options. Now, let's go back to this slide. Let's look at the out of the monies. What are the outs? Well, they're just the opposite. They have no intrinsic value. Now, don't confuse that to mean that they have no value. They might be incredibly expensive if they've got a lot of time, an expensive stock, 650% volatility like in GameStop. They could have a lot of value. They just don't have any intrinsic value, at least not right now.
Yeah.
And because of this, they will generally have relatively low deltas as a benchmark below 50. So for the call, the strike will be greater than the stock. And for the puts, the strike will be less than the stock. It's just the opposite. So let's go back to our $100 stock. If we have a 105 call, it's out of the money. And if we have a 95 put, that would be out of the money. All right, so that's part of our moneyness definitions right there for in the money and out of the money. What about the at the money? Well, let's start off with the one that everybody thinks is the definition. At the money options have no intrinsic value, but at the same time, they're not really out of the money. That's what makes them in their kind of this unique category all by themselves. So the definition that most people learn is it's where the strike equals the current stock price, or at least is very close. So it might technically be a little bit in the money or technically a little bit out, but we would still, in rough trading terms, we would say it's the at the money strike. And the key that you're going to need to understand for this presentation is those deltas will be very close to 50. Now, sometimes people say they're going to be 50, but they won't. They'll usually be a little higher for the calls because of compounding. But again, roughly speaking, about a delta of 50.
Mm-hmm.
So this is the kind of the dividing line where people say, oh, that's an at the money option if it has a delta of 50. And what we want to try to get you away from is that this is not the way you want to consider it. Don't think that it's where the strike equals the stock price. It might be. It might be very close, but it's really a bad assumption.
And it's also depending on interest rates, depending on time, depending on also, right? There's a whole lot of depends on if, but like Bill says, don't just say, hey, it's $100, so $100 is the strike price.
And I therefore have a delta 50.
Yeah.
Right. That's what we're going to show you is you have to be really careful about these very generalized assumptions that a lot of people teach. So let's come back here. So the question that we want now, if that's not really the definition, what is the definition? How should we look at this? Again, let's go to our bell curve. We know that stock prices roughly move according to the stock price changes definitely do move according to a bell curve. And the very center here is the current stock price.
Always.
So roughly speaking, there's a 50% chance to be in the money, 50% chance to be out of the money. And roughly speaking, I know some of the math people are going to disagree, and they're absolutely correct. But roughly speaking, the delta will tell you about the probability of expiring in the money. So this is why people say, oh, I get it. If the strike price is where the current stock price is, we got a 50-50 shot of being in the green here. So I must have a 50 delta. And again, what we're trying to show you here is that this is a really bad assumption. So
I got to say, Bill, I am not a fan of that definition.
I've never have been either. I know.
I'm just not. I don't think it really brings anything to the table.
It doesn't.
But it's in there. It is a definition.
Right. And again, if it's somebody's first day just going through definitions, I'd probably cut them some slack on that. But I think you want to really quickly get people back on track to say, or even while you're teaching it, hey, this is just with training wheels definition. I just want to let you know it's going to change, but for right now, it's okay. But you never hear that part.
I'm okay with that.
You just hear people say, oh, it's where the strike equals the stock.
Yeah.
Well, here's the problem. If we go to a pricing model, and remember, most options in the market are priced by professional traders, and they're going to be looking at pricing models. So the most famous being the Black-Scholes, but I'm just going to call it generically a pricing model. We'll see the at-the-money strike as what's called the forward value. You can also think of it as the future value. So what's future a forward value? Right. What's a forward value? Forward just means that it's just.
Go ahead. Sorry.
No, I was just going to say forward just means that it's going forward in time.
Forward in time, just like $95 today at 5% is worth $100 in a year. It's the forward value,
roughly. Yeah,
and you could work that backwards as well, right? You could say $100 a year from now is worth $95. You could buy them the $100 bill for $95 today.
It's going to be discounted. Yep, it's going to be discounted. So let's take a look at a $100 call. We'll say that interest rates are 5%. Now, again, this is the risk-free rate. We're going to give it 360 days to expiration. How does the pricing model see the at-the-money strike? Well, again, you ask the average guy in the street, they're going to say, well, that's easy. It's the 100. No, it won't. It's going to see the 100 strike times 5%
at the forward value, right?
As 105. So you can think of this as if you deposited $100 into a bank at 5%, you would have 105 in a year. That's the way that it sees the at the money strike.
And now even though it looks like it's out of the money,
oh yeah,
it's actually the 105, but it has how many deltas, Bill?
Going to be very close to a half.
Yep, 50 deltas. Right. So think of that cascade of like as I go further in the money, as I go further out of the money, how the deltas are going to be different than what you might have thought they were. And this is where the problems start to occur.
Yeah. And this is one of the things where we tell people, hey, even if you don't understand the math behind it, which is not really required, it helps, but at least look at your platform and see what the deltas are. Yeah. I mean, if you say, why is this showing a 65 delta and you can't explain it? Well, maybe hold off on the trade, or at least assume the platform's right and go with that, as opposed to saying, I read it on some website somewhere that this should be a 50 delta.
Or I saw some client on YouTube talking about it and he said it was 50. So, yeah.
Exactly right. So this is how the pricing model sees the at the money. Interesting. As Stu said, most people look at that and say, that's not at the money. It's out of the money. Well, Again, depends on what definition. If you want to look at it from a professional trading standpoint, this is the at the money strike.
And
now,
I would say that's the one that's out at the money. I would not say that the 100 is in the money. I would say that the 105 is at the money.
Oh, for
I'm
sure.
Trading with deltas, right? I don't know about
Correct.
you, but I'm trading with deltas.
Absolutely. Right. It's not the definition that matters. It's the deltas. So let's take a look at some examples, Stu, because I know sometimes this catches people off guard. Let's put the stock at 100, strike at 100. This is a pricing model, by the way, Black-Scholes, 360 days to expiration, 20% volatility, interest rates of 5%. And if we look over here, look at our delta. It's 63.
Yeah.
And yet we've got the 100 strike and the stock's at 100. This should be a 50 delta.
Yeah. Right.
Why is it 63? See, the pricing model says that this is an in the money option.
So what does that mean for your risk management skills? Does that mean that, like, if you really want to have a 50 delta option, now think about this. You really want to have a 50 delta option, but you don't have a 50 delta option. You have more than a 50 delta option.
Right.
Maybe you have too much exposure to movement.
Or you're on the other side and you have too little.
Or you're on the other side and you have too little, which
Right.
is the problem too, especially when you're starting to spread off and you kind of want to create a spread that has a delta. And here your deltas are all, you know what?
We're gonna do that example. I know you haven't seen it, but it's exactly where I was going with this. And that is one of the biggest problems that we see with the spreads. Exactly. Right. So that's what we're going to find out. So right now, I just want to show you that it's not 50. And yet the average person is going to tell you that this is going to be a 50 delta. Now, would it matter if we increase the days to expiration? Let's keep everything the same. Let's increase it to 1,080, Stu. That's 3 years.
Yeah.
Look at this. Look at our delta now.
Ugh.
72 delta.
It's even worse.
Not a 50
or
delta.
better, depending on how you
Exactly. Could be worse or better. So what we've done is we've increased the days and the delta got even bigger.
Mm-hmm.
But because this is really a function of the interest rate and the time. It's about this forward value. But now also, interestingly, we're going to come back and revisit this. Notice that your put is getting pushed out of the money.
Yeah.
Now, as a general rule, we're going to find out where there are violations of this as well. If we ignore the minus sign, if there's a 72% chance for the call to be in the money, what's called the complement, or the only thing remaining would be 37% chance for the put to be in the money. And if you add those together, you'll see that they're going to get you to at least pretty close to delta 1.
Yeah.
Now, and again, this is how most people assume that it works. And in most cases, it might. You need to understand when it does and when it doesn't. So,
which little side note here, which has nothing to do with this presentation, but I'm going to throw it in anyway. The call and the put together equal 1, right? But that's buying the call, buying the right, having the obligation on the put side, selling the obligation, put them together, and you have stock.
You got stock, which is delta 1, right?
Which is that's always going to be delta 1. Stock is always going to be stock. Doesn't matter if it's 100 or 500, right? 100 shares is always 100 shares. Just a little sidebar there.
And you're right. We could look at this synthetically and buy the call and have 72 deltas and sell the put. And that would give, because selling the negative would give us a positive. We would actually add those two together. We would be delta 1. It's another way to understand why long call short put is going to give you shares of stock. Now, another little side note too is that greater stock prices won't matter. I could come in here and make this stock price 3,000 and it's still going to give us 0.7249. It's a function of the time and the interest rates.
And the interest. It's the forward value of the money.
Right. And I'm sorry, of the strike price. Right. So we're looking at the forward price of the strike price. So as long as we leave that the same, we can pump up the stock price. It's not going to matter. But hopefully some of the people are starting to scratch their head and go, wait a minute, how are we at 72 delta? This should be deep in the money. It's only at the money. No, it's not. It's an in the money option. Because that's how and there's a very good reason for it. It's not just some quirk of the pricing model. There's a very good reason. We won't go into it here, but why the pricing model sees this as the at the money. So let's change the strike price now. What did we say the at the money was, Stu, for a 1-year option? Was 105, right?
105, yeah.
Let's go back to the original example. Let's give it 360 days to expiration. Let's crank up the strike to 105, where most people would say it's out of the money. And here we go. Now we've got our deltas fairly close to a half.
Pretty close to 50. Yep.
But also look, they're still not adding up to one. A little bit of a quirk here, but at least basically close. So we've got the strike at 105. That's what we've changed, and our deltas have come in. Now, what if we increase the days to expiration now? Let's go to 1,080. Now look what happens. We've got 1,080. Our deltas and our put deltas are not going to add up to one. So you want to talk about something that can really throw people. And they're going to say, why is this happening? My strategy should be doing this or should be doing that. And they can't figure it out because in their heads, they've got this idea of at the money's being 50 delta. And it just simply isn't. It's really just a bad definition. It's a little bit like the delta itself. If the stock price rises $1, that's way too big of a move. You really should be teaching it as if the stock price rises a penny or 5 cents, something really small, technically even smaller than that, but that's certainly going to get you closer than a full dollar. But I understand they do this to make it easier for students, but it can also really cause problems. Now, to take it a step further, Stu, we might look at this depending on our strategies and say, what if we want the deltas to be equal? Now we have to shift gears into another little unknown secret of the professional traders called an at-the-money delta neutral straddle. And what this is, it's the at-the-money delta neutral straddle. It means that the call and put deltas are the same. Now, that would be for a European style. There's a little bit of a math here. Don't worry too much about it. I just want to show you that it's not as easy as people make it out to be. What we have to do is to take our interest rate, add our volatility squared divided by 2. It's like a drift factor for the stock. Volatility in this example was 0.2 squared, which would be 0.04 divided by 2. And that's going to give us 0.07. I'm sorry, it's going to give us 7%. I'm sorry, it should be 5% plus that, which would give us 1.07 to the third, because this was for 3 years. And that would actually be a 22% increase in that strike price. So now look at this. Now we go up to 120.
And that's a lot.
That's a lot.
Yeah.
And so now I can get the delta to be 50 on my call, but now the put deltas are out of whack. If I change this to a European style, those deltas would be equal. So that's why I'm hoping that people are going, man, this is confusing. Good. That's going to show you. That's why you have to be super careful where you learn your options, your hedges, your rolls, and your morphs, because just something as simple as saying that the at-the-money strike is where the strike equals the stock can get you in a world of hurt. So now we've got the 122 strike, and there we go. Now I can get my delta down to 50, but now my put deltas are out of whack. So where does this cause a problem? Now, you had mentioned about spreads, and that's one of the examples I wanted to show. But if you have expensive stocks and long-dated options, the at-the-money strike can therefore be far above the current stock price.
And that, so let's say that whole concept gets exacerbated the higher you go, right? I mean, think of a stock like Booking.
Booking,
$2,500 stock. You might have an at-the-money option that's 300 points away.
For sure, easily,
right? or more. And when you start playing the wrong strike, you're going to really mess up your deltas.
You're going to totally be
right.
You'll be puzzled.
You might be betting down, but you're actually long delta, and it's
Oh yeah, we're going to look at an example of that in just a moment. So I was thinking the same thing here with Booking, or back when Amazon used to trade near 3,000.
Yeah,
people are looking at, let's say, almost 3 years to expiration, interest rates at 5%. We take the strike times the interest rate times the time to expiration. There you go. Almost 500 points. 500 points higher is the at the money.
Mm-hmm.
So yes, this can cause a world of hurt in your strategies just by saying, well, the at the money should have a delta 50. All right. So again, what we're trying to show is that there are a lot of moving parts in something as simple as really in day one. This is something that most people learn: in the money, at the money, and out of the money. It can start to get confusing if you don't understand how options work. So with that, Stu, let's go take a look at an example. I know you mentioned spreads. That's what I was thinking as well. let's say the stock is 400.
And by the way, everyone, Bill showed the 473 points away. If I went back to I just did this on my own pricing model. If the stock were 3,000, it would actually be a 72 delta.
Yeah.
So think about it.
Yeah, because it's going to get pushed way up there. So let's say that you buy a 1-year $400 put and you sell the 14-day 395. Now, a lot of times, this is why we typically tell people, this is a diagonal spread, why we usually tell people to put the long position in the money. But what most people do is they say, why would I want to pay for all of that intrinsic value if it goes against me? Let me buy the at the money and I'll sell the 395 because I think the stock is going to fall, not a lot, but I've got this wiggle room here of 5 points and I'm going to get these very high premiums for these, 1 or 2 week options.
Right. So you got to say to yourself, well, this spread here, is it long delta or short delta?
Right. And what do they think here, Stu?
Well, they think because it's a put spread and you're doing this diagonal and you're selling the lower strike, they think that it's a short delta put. And hey, you're already counting the money when the stock goes down.
There you go.
Guess what?
That's why Stu was the market maker for 29 years.
Yeah,
right. This stuff becomes very obvious. So that's what I was thinking here, that to the kind of the newbie traders, they would say, well, I want my deltas to be negative because I'm bearish. And so that's why I'm going to buy the 400 and sell the 395. So in their mind, they're thinking that their risk curve looks something like this. So the stock is right here at 400. And if it falls to 395, they're saying, okay, I've got these negative deltas down here. But what is it going to do? It's actually going to look like this. So if that stock moves from 400 to 395, you're actually long deltas.
You're long delta. You might even be long delta. You might even be long delta when you probably are going to be long delta when you start out and the stock's going down.
Or possibly, and it depends. You might be close to delta neutral, but you could be very long delta. Absolutely.
Yeah. So one of the things I coach is I take a look at your delta crossover point when you put these spread on, especially if they're long dated options. Make sure you kind of have an idea. I mean, you have to get it perfect. It's going to be dynamic and changing, but
correct.
Have an idea where those deltas are going to cross. So I don't want you to get stuck in a situation where you're actually long delta and you're thinking you want to be short delta and the stock's actually going your way. And here you're losing money and you can't kind of figure it out. Same thing on the upside. I don't want you to be short when you want to be bullish and your position is speaking otherwise than what you really want to be. And, you're having this big problem and,
Right. Now, the thing that's interesting about this is if you wait until expiration of the short, in this example, that 14-day option, you're going to go from the black line to the blue, and you will be negative deltas, but you got to wait all the way. You got to wait for 14 days to be on the blue curve. And what's going to happen, Stu? The stock's going to start moving in their favor. They're going to start losing. They throw up their hands and say, oh, it's because options are risky. It's not. It's because you didn't understand what an at-the-money option was. Something so simple as that can really throw a wrench into your outcomes.
I'm more concerned with what happens at 375, to be honest with you.
Oh, yeah.
Here I am synthetically long the stock from the 395
Look
put
at this
that I
going
sold.
Off a cliff.
I'm long the stock. I'm long the 400 put, 3 years out. It's like, hello, I'm getting my what handed to me.
Right. And they're thinking, oh, I'm long a long dated put. This is great. The stock is falling.
Yeah.
Well, no, it's not. You're barely short any deltas. You're long 100 deltas on this short position.
Yeah, go back to synthetic 101, long stock, synthetically long stock from the short put, long the actual put out there. We won't even make that the synthetic one. And long stock, long put equals long call, and the stock's going down and you're getting your butt kicked.
Right. Yep. So this is why we like to show people. I really like this presentation because it just shows a very simple kind of day one definition. In the money, at the money, out of the money. And people say, oh, I get it. Therefore, it's always going to be at the money where the stock equals the strike. And they go out with their strategies thinking, well, here's what I think the stock is going to do. It does exactly that. And then they end up losing and they can't figure it out. So I think the best way to describe it, and hopefully this presentation shows it, is that there are just a lot of moving parts. So again, even if you didn't follow the math, that's okay. We want you to take the point home. There's a lot of stuff that you probably didn't understand. And that's where the problems are going to lie.
Yeah. Yeah,
Absolutely.
there's nothing wrong with that spread if it's
No.
if it's creating what you want.
And
But
if
it
you're
may
willing to
not.
ride this, part of the plan should be you're going to have negative deltas not today, but over time. Well, that's different from saying I have negative deltas now.
Yeah,
A
because
very different thing.
things happen in like my grandmom used to say, in Mitten Drenham, in the middle of everything, what happened. So,
Yep.
It's kind of a good idea to kind of know where you are, so you can have a pretty much better idea of where you might be headed.
Absolutely. Couldn't have said it better. So, Stu, let's run back, revisit our question. Stock is trading at 100. You own the 1 year $100 call. Is this the at the money strike? So hopefully everybody out there can answer this and say, I guess on what to be fair, if we were back in COVID days and interest rates were zero, then yes, that would be. But if you have any positive interest rate, the answer is no, that's not going to be the at the money. Now, the smaller the interest rate, if they were 0.5% or 1%, you've got a 30-day option. Yeah, call the 100 the at the money strike.
There's no, listen, you got to think about it logically. There's no future value.
There's no future value to it. 6-month option, still basically 100 strike. You start looking at the $3,000 stocks at 5% or maybe possibly 6% here in the near future. 3,000 is not the at the money strike.
Think of it like borrowing money. If you borrow $100 at 4% for 2 weeks, does it really matter?
Exactly.
There's no money in it. But if you're borrowing $10,000 for 3 years, then it's going to add up.
Then that's exactly right.
Yeah.
Or even if it were 10 or 15% for a matter of days, it's not going to have a big impact. So if you're always trading something short term, you could probably use that as a definition of at the money. But when you start doing longs and shorts, and you think that the at the money is the one where the stock equals the strike, you can get yourself into a lot of bad positions that otherwise would have been good positions. That's the irony of it.
Yeah.
So I think with that, that wraps it up for here for this presentation. We hope that it at least gave you some good insights about why options can be so difficult. We don't think
pay attention to your deltas. Just if you're trying to create a delta, make sure the delta that you're creating is the delta that you want.
Is the delta that you want. Look on your face.
Make it happen, right? And a lot of people like to do these double diagonals, Bill, where they do the diagonal on one side using a very long dated option. They do the diagonal on the other side using
straddle swaps. Option. Yep.
And that's if you're not like on top of this, that's really going to mess up your so-called delta neutral strategy.
Oh, in a heartbeat.
Yeah.
Yep. Well, maybe we'll do that one. Do a straddle swap or something to do and look at variations of double calendars. All fun stuff. But again, what we're trying to show here is that we just want, if you're having less than acceptable performances or what you think you should be doing, especially if you seem to be getting the direction of the stock right, this is where the problem most likely is. It's not because options are risky. Trust me, they did exactly what they were designed to do. It's not because the market makers saw your order with your name on it and ripped you off.
Yeah.
It's because of this.
No, it's not because the Stu's ex-buddies on the floor ripped you off. It's not that way.
Right. So again, for anybody who wants some good information, please visit us, marketrebellion.com/get started. Lots of good information. And if you want to get a coaching session with Stu or one of our other world-class coaches here, please give us a call. And with that, Stu, that's about all that I have here for today. Any closing comments?
Keep the faith, man. Know your risk. Have a goal. Know what you have. Know where you're trying to get to, and have an idea of how to get there.
Absolutely, definitely have a goal. Can't even define risk without it. So with that, we want to wish everybody a great rest of the weekend, and hopefully we'll see a little bit of a continued what looked like a little bit of an attempt at a rally here and get us through these moving averages. But we'll come back and visit that next Thursday. So we'll see y'all then. Thank you so much.
Take care.